Hi, I'm Mollie Fadule, Chief Financial and Investment Officer at JPI, and today I have Jay Parsons, Economic Advisor to JPI and well-known economist in the multifamily and housing space, joining me. Jay, you and I have been talking a lot lately about volatility in the market with interest rates, credit spreads, a lot of the noise around tariffs, and the macro data that's coming in around the economics of GDP, employment growth, et cetera, moving around pretty significantly. From where you sit today, how do you see volatility shaping and impacting the multifamily development market?
Yeah, you're right. It's been a hot topic, and it feels like up until maybe a month ago, the story was that maybe we're starting to get to some sense of normalcy again. We got more certainty about where the market was going, and then of course, I think the tariff conversation has kind of given us a little more uncertainty again. I think that's been the main thing. Obviously, I think for those who are just tracking the headlines right now, it's important to know, and we'll get into more into this as Molly is into our conversation. It's not that the specific tariffs are causing more challenges in terms of just these deals penciling out. The biggest challenge remains with rates. Demand, fundamental demand for apartments remains really strong. We see a lot of good demand signals in terms of even renter financial health. Still good job growth, low unemployment, all those things are very positive. But certainly the recent noise has created some more uncertainty, and particularly the financial markets, and that makes the capital markets tighter. Seeing maybe a little more higher debt costs again, and some lenders and equity providers getting a little more conservative again. So we'll see how this plays out. But again, I think the underlying demand story is still good. We just have to work through a little more of this uncertainty.
Yeah, and with less new supply coming to the market today than potentially previously anticipated due to the current volatility, from our perspective, that makes 26, 27, 28 potentially look better from an investment standpoint. Obviously, volatility challenges aside and some of the decision making that happens from an investor perspective as it relates to market risk and volatility is real, but that does create a potentially even more attractive opportunity for us as we look towards lower starts this year than potentially forecast, meaning higher demand versus supply in the years to come as these projects are delivered.
Yeah, absolutely. I mean, I think that's one thing that people need to remember is that starts were already dropping off long before tariffs got in the news, and we're trending more toward mid 2010s levels of starts than even pre-COVID numbers we saw in the late teens. And so, already looking at a couple of years of low supply starting even late this year, in certainly 26 and 27, we're gonna have low supply numbers. And I tell people all the time, supply is the easiest thing to forecast. It's just starts being moved forward, and if anything comes out of this for developers, if there's one positive to all this uncertainty, for those who are able to get projects going, you're just prolonging likely the supply drought into perhaps 2028 from this current moment. So I think that makes it all the more attractive environment if you are able to get projects started out of the ground.
Yeah, that's right. We've talked a lot internally and with UJ about the cost of the potential tariffs, and obviously a lot of things moving around there. And while the headlines sound extremely dramatic, we've
Yeah.
seen home builders come out with earnings and talk about the impact that it would have on them being relatively modest. We ourselves have done our own internal research, and a lot of our peers seem to be mirroring the research that we have, that the impact is really right now, based on what we're expecting on the current policy that's been announced, is about 2% of total project cost. It'd be great to hear your perspective on the tariffs and how big of an impact they may have on both costs as well as what that might mean for the broader multifamily market.
Yeah, I mean, you're right, Molly, and I know JPI is obviously studied this in depth and updating this pretty much every month. And as I've talked to other developers and builders across the country, I've heard a similar story. It's low, maybe mid single digits at most, and people are surprised. People outside the industry are often surprised by this, but when you think about it, there's a couple things that have happened. Number one is most of what's been penciling out lately anyway has been wood frame, low and mid-rise apartment buildings we call garden and or wood frame stick buildings, and that's largely already using American lumber. So you obviously don't have an increase there unless American lumber providers start to increase those costs given the tariffs elsewhere. But that generally is not the issue. And another thing that we've seen is that a lot of suppliers and builders had already been diversifying their supply chains going back to 2018 when we first started to have a lot of conversations about tariffs, particularly on China. So we saw a lot of suppliers starting to move their supply chains into other parts of Southeast Asia and into Mexico. So, one thing I'll just point out is that obviously we're already in a tough environment where rates are higher, costs have gone up. So, any additional incremental increase in cost is certainly not a positive. A 1, 2, 3% increase is certainly not usually going to be the difference between a deal working or not working. So I think that'll be again, it's an incremental challenge. It's not a transformative one. The big transformative challenge was really the spike in rates. But Molly, I think this would be good to kind of dive into more. Is the supply chain topic is one I think a lot of the headlines have really missed this nuance. Like for people in the construction industry, the tariff issue is not a new one. Again, it really started back in the first Trump administration on the focus on tariffs, particularly from China. So let's talk a little about JPI. Do you have a sense yet of how much JPI is sourcing domestically, and can we discuss how maybe that impacts that potential tariff exposure?
Yeah, absolutely. A majority of our materials are sourced domestically, as you mentioned before, lumber being a large one of those. There is some limited sourcing that has been coming direct from China, including lighting. Interestingly enough, our key supplier there did indicate that they've already made plans to move to a different market for manufacturing. So I think there's a lot of that happening, despite our exposure being pretty small to China. Those that we do work with, they're working on new plans in order to avoid the potential tariffs. And, when this came up back in 2018, I would say we were more exposed as a company to the potential impacts of tariffs than we are today, because
Yep.
we have had time to think about diversification of our supply chain and reducing that reliance on goods coming in and from China. So while it does have a minimal impact, anything as it relates to cost today has an impact on the projects. As you mentioned, though, capital costs and labor are a larger portion of total deal exposure for us, and current a larger challenge than the tariff exposure. We continue to look at our estimates on impact of tariff on our projects as every new announcement is made. I think in April we did 3 revisions to that analysis, and we'll continue to do that. And we're watching it closely, but again, not a huge impact on our ability to still deliver projects at the return on cost that we think is attractive in today's market.
Yeah, I guess one other thing, Molly, as well, is that there's been a lot of conversation about you mentioned the labor market, and because of the slowdown in construction, we're not seeing across the industry these same spikes in labor costs that we had been. It's created a little more slack. So hopefully that creates a little bit of a counterbalance to tariffs as well.
Yeah, that's right. I think that, lots of new supply came on the market, and all of our trade partners have been very busy. And that's, a different case today than it was 2, 3 years, even in this last year, as a lot of that supply was being completed. And so we're now entering into a market where we're negotiating with our trade partners in a much different environment in terms of demand for their time and, allocation of that labor that they have on their overhead, looking to put it onto the next job. As we think about kind of the long-term view on housing, obviously there's some of the near-term market impact, also will impact long-term. But how do you think about long-term, looking at development of multifamily today, and how you assess the opportunity to do that?
Yeah, I'm obviously still bullish on development. I'll give you a few reasons why at a high level. I think number one is we still have a structural long-term shortage of housing supply. The actual number depends on which estimate you want to pull from, but no matter what they are, they all show that shortage in the millions. And so it's significant. And I think a lot of people get tripped over the fact they see words like oversupply, overbuilt. And I think those are misleading words, because really what's happened is that we just completed the most apartment units that we've ever built in our country in the most we've built in a 1-year period going back 40 plus years. And so you build that many units that tend to be concentrated in a finite number of locations at similar price points. That does create some short-term ingestion issues, but that supply is getting absorbed. It's taking a little bit longer but it's happening, and it's going to keep happening. And before you know it, the narrative is going to shift back to undersupply. Another reason for that as well is that the last big building wave, as I mentioned earlier, was really in the 70s and early 80s. That means that that product is now 40 to 50 years old. Some of that will be renovated, but others will be located in areas where the next generation of renters doesn't want to live, or maybe have seen so much kind of physical obsolescence that it's or a deterioration, I should say, that it's reached essential obsolescence, where the cost to renovate could exceed the replacement cost in some cases. So these buildings just get older every day, and what we've seen is there's been strong growth in the middle and upper income part of the renter market, which obviously caters to or is central to the demand pipeline for new construction. And so, and particularly in the markets that JPI is building in, these are growth markets. We continue to see growth in the young adult population that is central to apartment demand. So, those again, I think it'll be, but before we know it, we'll be talking about undersupply in certain markets again, because that demand keeps coming, but the supply is not. And so, again, given that it takes a couple of years to get a project, planned, approved, funded, built, and leased, I think, my belief at least is that those who are able to start projects now are going to be completing in a favorable environment when there's a lot less supply. And assuming the economy is in decent shape, we're likely to be seeing upward pressure on rents again at that point. So again, the crystal ball is not perfectly clear, but I think you can look at basic supply demand fundamentals, and I think it continues to point toward a need for more apartments in these next few years, and a lot less supply or a lot fewer developers able to build into that environment.
Yeah, and unfortunately, the current environment just provides for more workforce housing challenges, right? The middle income renters in America are further burdened, and the opportunity to buy a single family home in this current environment is incredibly challenging for them. If you look at, the rent to buy analysis and how much worse that's gotten over time, it does create demand drivers that just mean that, housing may become more expensive over time for those middle income renters that we'd really like to serve.
Yeah, absolutely. I mean, I think that we hear as a country this concept of this missing middle, and it has been a real challenge. I mean, all the time, just because you want to build more affordably doesn't mean the land seller is going to sell you at a discount, doesn't mean the construction crews are going to work at a discount, doesn't mean the material is going to be sold to you at a discount. And so you still have costs, and that's going to impact the rents. And so, what we're seeing is this real demand for not only affordable, which gets a lot of attention, but also this middle income workforce housing. And I know, obviously, Mollie, JPI is doing a lot to really focus in on this area. And so I think it'd be good to talk about it. But, it requires, I think, a lot of work, not only from the development side of, obviously, value engineering and really trying to see where you get your costs down. But again, at some point you're limited on how much those costs you can really get down. So oftentimes these public-private partnerships, whether it's, tax abatement programs or other incentives, are really critical to making these deals possible. And that requires real competence and understanding how to navigate those programs as well. But maybe we could talk a little more about some of the things JPI is doing to make that more viable.
Yeah, absolutely. As you well know, we have significant experience in structuring around potential benefits for workforce housing projects, and we've done it a multitude of times. And so that is a tool that helps us to improve the economics of the projects. But in addition, we've really taken a look at construction schedule in particular and planning in advance of being on the field and manufacturing the actual buildings themselves, to be able to have a designed plan that we really can execute in the field in a more efficient way. And so if we look at the capital structure of a project, time is a significant cost variable. And to the extent that you have delays in a project, that obviously costs a significant amount of money. And you're seeing projects that have had that in the past. On our side, because we do a significant amount of planning upfront, we look to avoid and even bring in the time schedule from our projects. So avoiding the need for rework, which can potentially cause delays. And so as we think about construction efficiency, it's both increasing our ability to produce more units in the field in a shorter amount of time, but also avoid those issues that create a need for contingency in the projects. No one ever plans for a project to be delayed, but when we look at the cushion that's underwritten into a deal, there's contingency built in on time and on cost. And it's our goal to be able to improve our planning to better increase our efficiency in the field to avoid the use of those contingencies and bring that schedule in from where it was before. And so we're seeing some real benefit in the field to some of what we've done on the technology side and the insourcing of some of the trades ourselves to be able to increase efficiency in the field and deliver the units faster, which is a big cost impact as you think about cost of capital.
Absolutely. And as you're saying this, I think those who aren't in this every day may not fully appreciate this, but there's only a certain number of groups who can even pull this off. Obviously, taking trades in-house, that requires an ability to take on those costs. But also, you mentioned technology. I've been just blown away in my time working at JPI, like realizing the investments that companies like JPI are making that pay off. Like thinking about, one of the things I heard about early on was, and I won't get the terminology right. You'll have to correct me on this, Molly, but like the helmets with the cameras on it, where you're able to, the crew's able to see, if a screw is in the right location. Because if it's not, you don't realize that for another few weeks. That's a significant delay, or could be a significant delay, and also some rework costs. So stuff like that. That may sound, I don't know, may not sound like that big of a deal, but those types of investments really are kind of feed into what the efficiencies and the value engineering that you're describing.
Yeah, absolutely. And that technology can't be used if we don't do a significant amount of planning on the front end to get the design developed to a level where that precision is available in the field by overlaying the image of what the design says the project should look like with what it actually does look like as it comes together. And that's been an incredible tool that we've been able to use to find issues as they're occurring in the field instead of having to deal with them later. And so that does help with us pulling in the timetables on knowing that we have a well-developed plan that has down to a very detailed level all of the design, which then when we're in the field, we're able to see any impact when that is not completed correctly. And of course, we know, in the field, there's a lot of work that needs to be corrected. But to the extent that we can find it earlier and solve it earlier, it creates a benefit for the overall project life cycle.
Yeah, absolutely. And again, that's a big advantage for groups like JPI. They're able to make that type of upfront investment.
Absolutely. And, really the technology stack that we've built over the last 4 years not only helps us in the field, but from the front end of, the funnel on the land chase side, we've built our own proprietary application there, which then is fed from both the design and a cost perspective on a cost database. We have real-time data on what we think each division of the construction budget costs because of the amount of data that we see in the market. That feeds into, scheduling and, project management software. And then, as you get into the operations and understanding where rents are and what's happening in the market in terms of concessions and volumes of traffic and conversions, all of that data we have on a proprietary basis, and we layer our own private data with public data that's available to anyone and everyone in the world, as well as a bunch of data sources that we buy. And when we overlay that all together and can look at the data that we have across a project life cycle, we think that helps us ensure that the projects will perform.
Yeah. And maybe one more thing I'd add on this too is that I think we're entering an opportune moment with this drop off in starts. It's coincided with a couple of things. Number one is there's this, I think, bipartisan movement for YIMBYism, the SMI backyard, and deregulation, reducing impact fees for development, all these barriers to construction. We're seeing this all the way from the White House down to individual states and cities, both red and blue, where there's this real push to, again, remove the barriers to getting housing built, and especially for workforce and affordable housing. So I think we're in a kind of an opportune moment to hopefully capitalize on that for the benefit of investors and renters and communities alike.
And a lot of, I think the challenge in terms of capitalizing multifamily development today is just looking at the screen and seeing, okay, how yields are trading, in the bond market or other things, and thinking about risk related to illiquid assets like, real estate and or development. And I think, there's a challenge for those that are just looking to find the best risk adjusted return in the market today. And, there's potentially other options outside of multifamily development. But for those that are looking at a diversification strategy that includes being invested across a multitude of asset classes, taking on both illiquid and liquid risk, and across the illiquids, taking on, things like multifamily development, logistics, other type of sector investment in the real estate space, it seems like it's still an interesting time. But for those that are looking for just the highest yield without taking into consideration a diversified strategy, it's a lot harder to convince yourself to do development today.
Yeah, absolutely. And it's a fair question, but I also like to remind people real estate is more illiquid than, stocks or something else. I will tell you that, apartments are more liquid, in this era than at any point in history. I think that's because of a few things. Number one is the demand dynamics in our country. Obviously, we've seen so much, and we've just since COVID, we've added some more than 1 million apartment renters into this country. The average costs all in monthly cost for a new home buyer are more than $1,000 a month higher. In some markets, close to $2,000 a month higher than your average monthly rent for a new buyer versus a new renter. That's going to continue to keep people renting for longer. So those demand drivers are there, but also I think the increasing quality of these assets that we're building. They're used to be that that apartments were just people lived in apartments because they had to, and now we have really nice apartment buildings in great locations that are designed for an optimum resident experience and create a very sticky experience as well. That makes these assets more liquid, as well as the fact that we've seen obviously challenges in office and retail that's driven more capital into the multifamily space. There was just recently a survey done by AFIRE, which is a big international group of real estate investors, and multifamily is the sector they like the most. And so, again, I think there's value in having a diversified portfolio and specifically having some real estate exposure. But, within the commercial real estate buckets over these last 15 years, it wasn't just COVID. It really started after the great financial crisis. We've seen apartments have become really the golden asset class in commercial real estate. And I think that this next cycle I don't think anything's going to change that. I think this next cycle really further cement the status of multifamily as a high value liquid asset class and a top performer in the real estate category.
Yeah, absolutely agree. As we know, there's record amounts of dry powder waiting to be allocated and invested across the real estate, and a lot of that is bucketed towards multifamily. And we've continued to see investors show more and more interest in multifamily and multifamily development over the last, I would say 6 months since interest rates really started to come down. We've seen more and more interest. That being said, some of the volatility, obviously has been concerning to some investors, but many folks are still looking to find good developers that have attractive opportunities to invest in this sector. And we hope that continues, because the more units that can be developed across the US, the better it will be for your middle income renter and for all asset classes, no matter whether we're developing a high income project or a low income affordable housing project. Any unit that delivers onto the market, we think, has a benefit for everyone.
Yeah, absolutely. And I think as I talk to investors across the country, what I find is everybody still gets the multifamily story. They understand the need for affordable workforce and even market rate housing. That's not a hard sell. I think the issue is always timing. But if you believe the long-term demand drivers, you believe in the story for multifamily, then as the market gets further tightened, it's only going to get more expensive at some point. And so I think it's really just a question of why not now? And again, you look out a couple of years, these projects complete, it's going to be a lower supply environment. We don't know what the demand environment will be exactly. We don't know what the rent environment will be exactly, but we do have a really good idea of the supply environment. And again, we know we're structurally undersupplied. We know we're going to have a lot less supply in that period. And so I think that's only going to increase the appetite for multifamily assets in an environment where demand could exceed supply.
Yeah, absolutely. Well, thanks, Jay, for joining me today. As always, appreciate your insight. And if you guys are interested in learning anything more, feel free to reach out to either Jay or myself, and you can find more information at www.jpi.com.